Hello everyone and welcome to today's session where we would be discussing two very important concepts within the valuation of bonds chapter, that is duration and an allied concept of convexity. We will be discussing this along with a sum which has come in the November 2020 exams, and the same sum has come even in the May 2023 RTP question number 2 or so if I'm not wrong. So we will discuss the concept along with the sum. It is also similar to I think question 24 of our books. Having said that, we'll do an overview first of the concept, try to calculate the numbers and then apply. So first we'll understand duration, do the part of the questions which pertain to the duration, and then go to convexity so that both of them are understood fairly well. From an exam perspective, duration is a lot more important as compared to convexity. So what do you mean by duration? I'm assuming that you have some basic understanding of bonds where bond value is nothing but the present value of future cash flows, or the bond return can be measured considering the current yield, that is interest by price, or let us say realized yield or yield to maturity, which is the rate that you earn if you were to buy the bond at today's price and hold it till maturity. So these are all return concepts. When I look at duration and convexity, these are like risk concepts. These help you in measuring bond risk. Now, how do you measure bond risk? One part of the bond risk measurement is looking at the credit rating on whether we will be able to repay the cash flows. Now, assuming that the issuer is able to repay the bond cash flows, then what is the source of bond risk? Well, for a bond investor, the three core features of a bond involve the maturity, involve the coupon, and involve the discount rate. That is how the value of the bond is determined. So each of these factors have a different impact on the measurement of bond risk, and duration is a number which considers all of these three factors into the bond risk working. So what we'll try to do is we'll try to do a basic conceptual overview of duration, go to the question that we have over here, which is the November 20 and May 23 paper, do the part linked to duration, then come to convexity and do the part linked to convexity. Okay, so let us first go to duration. What do you mean by duration? Well, duration is the time-based weighted average. So how do you calculate duration? Duration is calculated as summation T into the PVCI at each of the levels upon summation PV of all CI. Now this formula is not really insightful. When you actually look at this formula, it does not give you a lot of insight. What does this formula try to indicate? Well, this formula tries to indicate over here that if there is a bond with a, let's say, a 6-year or a 5-year time frame, I will try to find the cash flows at each of the years, discount each of these cash flows, and then do a time-based weighted average. So I will take the time, that is year 1, then multiply it by the present value of cash inflow, then add to that year 2 into the present value of cash inflow at year 2, and so on. So that is a mathematical process. What are we ultimately trying to achieve? Well, I'm ultimately trying to achieve a number which will be very similar to an average due date or a discounted payback number. So assuming we take a sum and we understand it better, but before that, assuming, let us say it's a 6-year bond which is giving me cash inflows in each of the years, and I want to find the risk, I will say that like I do for the payback period, how far in the future. Now the bond is going to give me various cash flows, year 100, year 200, year 300. Okay, if instead of paying all of these cash flows at different dates, if a single cash flow were to be paid at a single date, what date would that be? Sir, if it is a zero coupon bond, well, no cash flows were paid in each of the years, then everything will be paid in the 6th year only, so duration will come to 6 only even in this formula. However, if it's a coupon bearing bond, then there will be some money which is received in year 1, some money which is received in year 2, some in year 3, and so on. So instead of receiving these monies at different points of time, if a single amount is paid at a single date, which date would that be? That is represented by duration. Alternatively, this can also be referred to as a concept which is similar to a payback period, where we are trying to say that, well, after how many years can we say that the bond is recovering its investment? So as to say, the shorter the duration, lesser the risk, longer the duration, more is the risk. When I look at this duration number, it takes all the three important factors of the bond into consideration. It takes the T, that is the years, and the maturity. It takes the cash inflows like the coupon, and it also takes the present value, that is the discount rate. So all the three measures of bond risk are considered into this calculation. It is basically taking T and applying the present value of cash inflows as weights. So again, we understand this better when we do a numerical. However, the term duration, a lot of students don't even understand in deep terms what is duration. Duration, Maxwell's duration to be precise, is a measure of bond risk which tries to measure in yearly terms that for instead of receiving cash flows at different points, if I were to receive a single cash flow at a single point of time, how far would that be? The further it is, the more is the risk, the nearer it is, the lesser is the risk. Similar to payback period. Over here, what is the use of finding this measure of risk? Like in your shares, we try to find beta. What is ultimately the objective of finding beta? It is helping you to find the responsiveness of the share to movement in the overall market. So in a share, what does beta do? If let us say the market moves by 10% and the beta is 2 times, we say, okay, if the market is moving by 10%, then our share should, roughly speaking, move by 20%. However, in case of bonds, what is market? Well, bond has 3 core features. One is the maturity, one is the coupon, and one is the discount factor, which is the market rate of interest. Now, typically, the maturity as well as the coupon will remain the same. So, if the bond's price has to change, it will change if the market rate of interest increases or decreases. Like RBI increases the repo rate, the bond price will change. But we want to figure out by how much will it change. Like if the Nifty changes, then we say that, okay, the returns of each share will change, but by how much will it change is measured by beta. In a similar way, if let us say the market rate of interest changes, maybe because RBI increases the repo rate or the inflation is high, whatever is the reason, then by how much will the bond's price change? This is measured by a term called as volatility. In order to calculate volatility, we modify the duration number to some extent. We kind of say that, well, among all the core features of the bond, why would the bond's price change? The bond's price change if the yield, that is the discount factor, undergoes a change, and hence the formula for volatility, or also called as modified duration, is the Macaulay duration upon 1 plus the existing YTM. So, for example, your current rate of interest is 10%, RBI increases it to let us say 12%, in which case we will say that whatever is the Macaulay duration divided by 1 plus YTM, existing YTM, let's say 10%, 1 plus 0.1 will give you the modified duration. Now, what is the significance of modified duration? Statistically, it has been seen that the change in the price of the bond is let us say similar to the modified duration number. So if there's a 1% change in interest rate, say there's a 1% change in interest rate, and let us say the modified duration was 4, for a 1% change in interest rate, it can be said that the bond price will change by 4. Okay, but will the bond price go up or will the bond price go down? Well, it depends on whether the interest rate is increasing or decreasing. Remember, there's an inverse relationship between interest rate and the bond prices. So if the interest rate is going up, the bond price will go down by 4%. If the interest rate is going down by 1%, then the bond price will go up by 4%. But sir, what if the interest rate is going up by 2%? Then we are saying that on a 1% increase, the bond price would have fallen by 4%. Then for a 2% increase, the bond price will fall by 4 into 2, that is 8%. So over here, when we are looking at the duration, the final impact of duration is it helps in predicting the responsiveness of a bond's price in response to a change in the market rate of interest. In general, the longer duration bonds will have a higher sensitivity, a shorter duration bond will have a lower sensitivity. The rationale over here is because if it's a 20-year bond and if the market rates of interest keep on increasing, you as a bondholder are stuck with lower coupons for a long 20-year period. Whereas if it's just a 20-month bond, then you as a bondholder are stuck with the lower coupon as compared to the market rate for a 20-month period only. And as a result, a shorter duration bond intuitively has lesser risk as compared to a longer duration bond. On the other hand, risk also has a reward. So if the market rates of interest keeps on going down and you have a bond with a high coupon relatively, in which case you are going to get a higher reward over the next 20 years as compared to a shorter duration bond, and hence the responsiveness will be much higher. Like in case of equities, if there's a high beta stock, it performs really well in a bull market, but then it loses a lot of value in the bear market. In a similar way, in a rising interest rate scenario where bond prices are falling, ideally you should move out of longer duration bonds and come to the shorter duration bonds. That is bond strategies, a separate discussion. And if the market rate of interest keep on going down and bond prices are going up, then you should try to shift your money in the longer duration bonds for a better return. So duration kind of helps you in understanding the responsiveness of a bond's price to a movement in the market rate of interest and helps you in a way in formulating bond strategies as well. So what we will do is, before we go to convexity, we will try to first understand the impact of what duration has. So before we go to convexity, which is not as important honestly as duration is, we will try to do the sum. Go to the question over here. This is similar to question number 3A of the November 20 exams and RTP question 23, May 23, question number 2. So we'll go through this. It's similar to question 24 of our books as well. Over here, the new term is convexity. We'll do convexity the way institute is doing it. There are alternative ways in which it can be done, but we'll do it the way institute does it. Let us first focus on the duration part and then go to convexity and the related sum. The following data are available for a bond. The face value is 10,000 rupees to be redeemed at par on maturity. So the redemption is also happening at 10,000. Coupon rate is 8.5% per annum. And years to maturity are 5 years. Yield to maturity is 10%. So this is your discount factor. You are required to calculate for the bond current market price. Now the current market price is calculated as the present value of future cash flows. Okay, usually intuitively what we have studied in class as well is if the bond has a coupon of 8.5 and the required rate of return is 10, so this bond is giving a coupon which is lower than the required rate of return, so it's kind of an inferior bond, and hence if you look at the value, the market price should be lesser than face value, so your answer should be lesser than 10,000 as a cross check mechanism. Second is a Machiavelli's duration, and third is a volatility. So these three things we will do. Then the question says convexity of the bond. So we will try to in brief understand the concept of convexity and then come to this area. Expected market price if there is a decrease in the yield to maturity by 200 basis points. Remember, 100 basis points is equal to 1%, so 200 basis points will be 2%. So there is a decrease in the yield by 2%. So you have to find the expected market price by the Machiavelli duration estimate and then by the intrinsic value method. Intrinsic value is considering the present value of future cash flows. Now future cash flows earlier were at 10%. Now this 10 is falling by 2 and hence your required rate of return is 8%. So we say that okay, let us try to find the present value of the agreed cash flows at the rate of 8%. That is the intrinsic value method, or take the duration as a base and try to predict the value. So we will also try to do 0.5. Here you are not looking at convexity. It says by the duration estimate. Okay. So it is only 0.4 which remains. Other than that, we can try to quickly try to do this working. So over here for this question, we will first try to find, or we usually try to prepare this table. So over here you will have years 1, 2, 3, 4 and 5. The cash inflows that I get in each of the years, 10,000 into 8.5%, that is I think 850 in each of the years, and in the last year 10,850. Now this is going to be discounted at the existing rate, which is 10% per annum, and as a result over here we will take are there discounting factors given? Well, yes, at 10%, 0.909826. So this is given, so you take that. If these were not given, we typically prefer taking up to 4 decimals, rounding off the fourth number. Having said that, you can also take something else. So this is 0.621. So these are the different values given, and we try to find the PVCI. So over here, this is to find the current market price. An easy calculation, 850 into 0.909 m plus 772.65, 850 into 0.826, 702.1, 850 into 0.751, 683 or 638.35. I mean, all of this have been given as well, but I mean, just as a flow, we complete the calculation. So this is 580.55 and then 10,850 into 0.621 and you get 6737.85. Memory recall, this is 9431.5. So this is the present value today. So the question says you calculate the market price. This is bond valuation 9431.5. So this is 9431.5 as we say. Now if you want to calculate Machiavelli's duration as a second part, Machiavelli's duration is calculated summation T into PVCI. Now I found the PVCI, I have the T, so this years is the T and I have the PVCI upon summation PV of all CS. So mathematically calculating the duration number is fairly easy. Understanding it is a little tricky. So over here, if I do T into PVCI, I will multiply these two columns and keep on putting everything in the memory. So over here, this is 1 into 772.65 m plus, so this is, let's say, 772.65, 2 into 702.1, this is 1404.2, 3 into 638.5, this is 1915.5, 4 into 580.55 m plus, this is 2322.2, 5 into 6737.85 m plus, and you get 33,689.25 memory recall, and you get 40,000 103.8. I hope I have not done a silly calculation mistake. So that's approximately the same. So this is 40,000, 103.8 upon 9431. So over here this is summation of all cash inflow. So basically you are taking the weighted average, you are taking T as a base and then PB of CI is the weights. So over here divided by 9431.5 and you get approximately 4.25. This is measured in years. Now what does this number indicate? It indicates that rather than paying all of these terms at different times, if I were to pay a single value at a single date, what would that date be? Well, that will be 4.25 years away from today. Again, this is a case where the coupons are paid in each year and the principal is paid at one shot at the end. Alternatively, if you were to compare this with a bond where you are agreeing to pay 2,000 of principal in each year, your interest will obviously be lower. However, the duration will be significantly lower because a lot of the money is recovering a lot more earlier. So this is like the duration. Now, if I were to calculate the volatility, I ignore the year part over here. We say, okay, the Machiavelli's duration, which is 4.25 upon the existing YTM, which is 10%. So this is 4.25 upon 1.1. This is through regression or derivative analysis. So this is 3.86. So over here 3.86 is considered to be the volatility, in which case we have found sub point 1, 2 and 3 in sub point. So this is 4.25, this is 3.86. Convexity is still remaining and the expected market price if there is a decrease in yield by 200 basis points. So this is sub point 1, this working is for sub point 1, this is sub point 2, this is sub point 3. You go to sub point 5 now. So if I am going to sub point 5, I want to find the expected price first using the duration estimate. So using the duration estimate, what is told? Using the duration estimate, delta I, that is a change in I, the yield is falling by 200 basis points, that is 2%. Acha, what does financiary tells you? It says that if the yield falls by 1%, so if there's a fall in interest rate, the price will go up. Now the price delta P, that is a change in price, should be how much? Well, that will be equal to the modified duration, so that is 3.86%. So over here, if there is a change of 2%, the change in price should be how much? Therefore, for a 2% change, you will find the change in price to be, let us say, 3.86% into a negative 2 upon a negative 1. Now, negative and negative will in a way offset, and hence this is approximately 3.86 into 2 comes to 7.72%. So this is like 7.72%. Acha, therefore, the revised price using the duration statistic will be 9431.5. If the market rate of interest goes down, the bond price goes up, and we have said it should go up by 7.72% into 9431.5, and as a result over here this will be 9431.5 plus 7.72% comes to approximately 10,159.61. So this is the expected price using the duration statistic. Subpart B of the question says using intrinsic value. Now intrinsic value is nothing but the present value of future cash flows. Over here we can use the annuity tables because the cash flows are constant, so we can use the annuity tables. So we could have also used the annuity tables in sub point 1. Yes, you could have, but you had to calculate the duration, so you would have in any case had to prepare the table. So over here using intrinsic value, that is the present value of the future cash flows, if I were to do this working, then this working would be, let us say, the 850 into the present value annuity factor at the rate of 10 minus 2, that is 8% for a period of 5 years, plus we are also going to get back 10,000 of principal into the present value factor at the rate of again 8% for the 5th year. In which case, do I have these values? Well, yes. If you look at all of these numbers, 0.926, 0.857, 0.794, 0.735 and 0.7681. So this I guess comes to 3.993 if I am not wrong, and into 0.681. So if you look at these workings, this is 850 into 3.993 m plus, this is 3394.05 plus 10,000 into 0.681 m plus, this is 68. 10, and hence if I total up, I can see there is a slight difference. This is 10,204.05. Now on a 10,000 base, if I go to see, the prices are not exactly the same. The price is predicted by the duration statistic is around 10,159, whereas price using the intrinsic value method is around 10,204, and as a result there is, we can say, approximately a 40 or 45 rupee difference in the prices. Now why is this difference in the prices arising? Now conceptually, this is where convexity concept comes into the base. So here we discuss the concept of convexity. Now convexity over here arises because of this difference, because duration is unable to predict the price to utmost accuracy. And why is that? Because when the yield to maturity is 10%, we found that the duration was 4.25, and based on that we found that the volatility came to 3.86. Now I am not going into too much technicality. However, one needs to remember, and you must have probably done sums on this as well, as the yield to maturity changes, let us say to 8%, one needs to acknowledge that your duration will also undergo a change. Your duration does not remain the same. If you want, you can do this calculation as well. So over here, I mean, this is not required. This is just extra working because we are going into the convexity concept. So over here, 1, 2, 3, 4, 5, we're just adding some additional burden for our overall understanding. So this is 850, 850, 850. And if I had to do the working, 10,850, discounting factor at the rate of 8% is available. So this is, let us say, 0.926, 857, 926, 857, 794, 735 and 681. 735 and 681. So if I were to find the present value of cash inflows and then do T into PVCI, let us say, then you can do all of these numbers, you can do the individual calculations. We know that the total present value of cash inflows, let us say, will come to around at 8%. If we do the value, it comes to around 10,204.05. So let us say 10,204.05. I'm just skipping up into the individual calculations, and other than that, this is 1 into 850 into 0.926 m plus, 2 into 850 into 0.857 m plus, 3 into 850 into 0.794 m plus, 4 into 850 into 0.735 m plus, 5 into 10,850 into 0.681 m plus. I'm sorry for blabbering a lot of numbers. So this comes to approximately 43,711.95. You can verify this at your own pace and convenience, but the duration, the point that I want to draw home over here is 43,711.95 upon 10,204.05. So this will come to 10,204.05. So this will come to, let us say, 4.28. As you can see, there is a very small difference, but there is a difference. Your duration is not exactly the same. Mathematically over here, as you see, since the discount factor changes, the duration itself undergoes a change. The duration itself undergoes a change, and if the duration is undergo a change, so will the volatility. So for example, I will do 4.28 upon, let us say, 1 plus the existing YTM, which is now 8%. So this is 4.28 upon 1.08, and let us say this comes to 3.97, which is different from 3.86. As you can see, duration is changing, volatility is also going to change. However, what we are going to assume in this number is a static measure of duration. We are saying that, well, you know what, when we move from 10 to 9 and then we move from 9 to 8, the change on 1% is around 3.86. The change for another 1% is also 3.86, and hence effectively we are saying that for 2% change in interest rate, the price change will be 7.72% as predicted by the duration number. However, when we look at the actual change is going to be different. And sir, why is it going to be different? That is the rationale that we are seeking. Why do we need to do convexity in the first place? It is going to be different, as since the rate of interest changes from 10 to 9, changes from 9 to 8, for example, the duration keeps on changing, and the rate of that change is measured by convexity. This is the birthplace of convexity. So the rate of change is measured by convexity, and mind you, this is not just at the rate of 8%. Even if it goes from 10 to, let us say, 12, there's a 2% fall, there can also be a 2% rise. You will find that your duration does not remain static at 3.86. The duration undergoes a change, and that is what we try to find using convexity. So over here, how do you calculate convexity? So we understand that the birth of convexity, we first need to understand convexity is a very, very complex term. There are various ways in which you can calculate it. Institute does it in a slightly simple way. We will also address that way, but I want to explain to you the nuances that go behind convexity. So over here, let us say we were to also do, this is all extra working, this is not to be shown in your exam at so much length. However, let us say if I were to also do a similar working for moving hypothetically from 10% to, let us say, 12%. So there's a 2% fall we studied. Let us study what happens if there's a 2% rise. We will do all of this. Then we will see how a sum has to be solved. So over here, let us say if I want to find a value when the rate of interest becomes 12%, we will do the same working. Let's say year 1, 2, 3, 4 and 5. By now you would be fed up seeing 850 again, and this is 10,850. The discounting factor at this point is now 12%, and hence you do, let us say, 1 divided by 1.12. We will keep it to 3 decimals because everything else in the question is at 3 decimals. 0.893, 0.797, 0.711 or 712, 0.636 and 0.567, and we get PVCI and T into PVCI if we are interested in finding the duration as well. So if we do run a few calculations, we will get 850 into 0.893 m plus, 850 into 0.797 m plus, 850 into 0.712 m plus, 850 into 0.636 m plus, 10,850 into 0.567 m plus, and our favorite MRC, this will be 8734.25. Acha, if I want to find the duration as well, I will say 850 into 1 into 0.893 m plus, 2 into 850 into 0.797 m plus, 3 into 850 into 0.712 m plus, 4 into 850 into 0.636 m plus, 5 into 10,850 into 0.567 m plus and MRC. So this is around 36,000. 851.7, and hence if I want to find the Machiavelli's duration at this point, this will be 36,000. 851 question has not asked you any of this, and hence these are extra workings. 36,851.7 divided by 8734.25, and hence 8734.25. as you can see, this is around 4.22, which is different from 4.25. and if I were to calculate the volatility, this is 4.22 upon 1 plus 0.12, which comes to 4.22 upon 1.12 comes to around 3.77. as you can see, we assumed that when we go from 10 to, let us say, 11, and when you go from 11 to, let us say, 12, duration number would have assumed that the change over here for a 1% change in interest, it would be 3.86%, maybe negative. 1% over here would be 3.86, another maybe negative, but, and hence a duration number would have said that for each change in interest rate, your market price is going to fall, in this case, by 3.86, and hence the effective fall will be 7.72%. However, if you actually go to see, the volatility at this point is around 3.77, it is something else, and hence there is a slight difference. There is a slight difference. So over here, if I had to find the price as per the price as predicted by the duration statistic, the price as predicted by the duration statistic, the price as predicted by the duration statistic would be 9431.5. This was the price at V0, at your original 10% rate. This was the price. Now, if the rate is going from 10 to 12, there is an increase in rate, so the bond price will fall. So this will fall, let us say, by 7.72% as per the duration number into 9431.5, and hence this will come to 9431.5 minus 7.72% comes to around 8703.39. Now, why am I discussing all of this? If I were to summarize, then at V0 is at the rate of interest today, that is 10%. There is another term called as V plus, that is a higher value. at the rate of interest of 8%, what will be the value? V minus is the value at 12%, what will be the value? So the value as predicted by the duration number. Now today, let's say we are starting at 9431.5 and value as predicted by the duration number was at 8%. The value as predicted is 10,159. Okay, so this is 10,159 point something, and at 12% the value is 8703.39. okay, this was 0.61. Why are we doing this? I'm trying to explain to you why is it called as convexity. If you remember, there are two shapes that you might have studied in school. One is the convex shape, something like this, and one is the concave shape, something like this. I'm not sure whether this is really helping you in terms of the shape, but if you remember a convex shape and a concave shape, we are calling it as convexity and not concavity. Why? We are trying to understand that. So the price as per the intrinsic value, that is the present value of future cash flow. Let's say at the base is 9431.5. However, when it increases, this is 10,204 point. Now things should hopefully fall in place. If you have survived till this point, then things should hopefully fall in place. Now this is 10,204.05 and this is intrinsic value. If I were to calculate, this is 8734.25. So this is 8734.25. This is a value that you calculated as a present value of future cash inflows, and there is a value as predicted by the duration statistics. So over here, what we are trying to say is duration, in a way, if I were to make this as a graph, this data set, if I were to make this as a graph, when I move from 10 to 8, duration believes that my price will be 10,159. However, my actual price is higher than 10,159. So duration believes that my price will increase and it will go from 9431 to 10,159. It will actually go up. It will be more. So it will be 10,204. When the interest rate increases, the bond price will fall. Duration believes it will fall all the way down to 8703. However, it will not fall to 8703. It will be slightly more. That is 8734. The reason behind this is the duration keeps on changing. But if you were to plot this in rough on a very simple chart, what would happen over here is, if you take let us say the price on one side and the rates on the other side. So over here, if I were to plot this, what will happen is that, let us say at a 10% rate, loosely speaking, at this point this will be 9431. Now duration will say that as I move from 10% to either 12% or I move from 10% to, let us say, 8%. If I move to 8%, the price will actually rise. If I move to 12%, the price will actually fall. So duration assumes a linear change. It assumes that for every 1% change, the rate of change is the same. So over here, as per duration, at a 12% change, duration believes, so this is, let's say, 9431. Duration believes this will be 8703. However, your actual price is somewhere above. This is 8734. This is the true price. At 8%, duration believes that the price over here will be approximately 10,159. However, actual price as you calculated over here is around 10,204 approximately. I don't have a graph paper over here, but I want you to understand the essence. So when you actually build up a line or a curve connecting, this is a curve which is going to form a shape of a convex item, and hence this difference, as you see, is largely arising due to convexity. So this, if the actual price would be the same as that predicted by the duration number, that is a linear change, in which case your actual price should have been 8703 or 10,159. So the difference between these two is the source of this convex shape, and hence that is called as convexity. So over here I rest my case, where convexity, how do we measure convexity? Convexity over here, institute says, is a very simplistic way. If you look at CFA curriculum, etc., they have a slightly more complex way, but we will follow what the institute has done both in the November 20 paper as well as the May 2023 RTP. So what does institute say? Well, this difference is the source of convexity. So if I want to measure the convexity, institute says convexity, or C, can be measured as V plus, add to that V minus. Sir, what is V plus? It is a higher value, higher actual value, not the value as predicted by duration, higher actual value. Okay, to add to that V minus, and minus 2V0. Divide this entire term by 2V0. So over here, I mean, there will be another adjustment that you do of change in YTM squared, but keeping this adjustment neutral, ignoring that for the time being without any other adjustment. We will say, what are we trying to say? We're trying to say that ideally if the change is linear, let us say for simplicity, if I go from, let us say 100, if I go down exactly by 20 and I go up exactly by 20, go up also exactly by 20. So if I do 120 plus 80 minus 2 into 100, my numerator will become 0 only. However, if my actual increase is 121 and when I go to 80, it is actually 81, in which case this will not be 0. This will be, instead of 120, it went up. Kitna? It went up to, let us say 121. So that 1 over there, as well as instead of 80, it goes to 81. So that 1 again over there. These are the sources of convexity. So this 2 is the source of convexity which I want to find. If the actual change was linear, the answer would have been 0 in the numerator. However, the answer is actually 2. And that is because of the convex nature, and the convex nature is because of the dynamic nature of duration. As rate of interest changes, the duration keeps on changing. That is the core reason behind all of this. So over here, this comes to, let us say, 2 in the numerator. Now what is happening over here is, when you have done portfolio, if you have to calculate a percentage, you do P1 minus P0 upon P0. So you are saying that, okay, P1 minus P0, this is the total value minus the starting value upon the starting value. So that is why you divide this also by, let us say, the value at 10. Now, why do you do a delta YTM squared? Now, to be honest, if you even did not do that, Institute does it, so we are doing it. Even if you did not do that, it should have been fine. Like, duration is a first derivative of the interest rate. So as interest rate changes, duration will result in the price to change. When you look at convexity, it is like the second derivative. Like in your integral calculus, you do dy by dx squared. So this is like rate of interest changes, it will have the impact on duration, and consequently duration changes will have an impact. So this is like the second derivative, and hence you do delta YTM squared. Now, at the end, the effect of delta YTM squared will nullify, as you will see further. But for the time being, if Institute is writing that in the denominator, write that as a denominator. Delta YTM is the change in the YTM, that is 2%. Sir, but how will we determine V plus and V minus? Well, you will try to find. Now, this is how your exam question will appear. This is where you start solving. All that I've explained earlier is concept. It is for logical understanding. If we get, excellent. Otherwise, from an exam perspective, we will take V0. V0 is the price at the existing YTM, that is 10%, which you must have calculated as, let's say, 9431.5. Now, you will take two other values. One is V plus, that is a higher value, and V minus, which is a lower value. Now, this can be at any rates, but the rate of change should be the same. So, you can either do at 9 and 11, so you plus and minus 1%, or you can do at 7 and 13, that is plus and minus 3%, or you can do at 8 and 12. Any of these numbers work, but the rate of change on the upside and downside should be the same. So over here at one of the places, we have been told that the YTM changes by 200 basis points, and in 0.5 we have already reduced it by 2%. So over here at 8%, your actual value is 10,204.05, I guess. Okay, and hence, okay, this is already calculated in 0.5, this is already calculated in 0.1, and hence you just need to do an additional calculation at the rate of 12%. And this can either directly be done by 850 into the PVAF at the rate of 12% for 5 years plus 10,000 into the present value factor at the rate of 12% for the 5th year, which you can calculate, and this will come to 8734 approximately 0.25. So this is the only calculation. You don't have to sit and do the duration numbers. This is just to showcase to you conceptually that your duration does not accurately predict the price. There is a small change, but there is a change. As the durations, as you could see conceptually, they're not the same. It is not 3.86 at each level. They are changing. So that is what I wanted to point out, and hence I did so many calculations for duration. Having said that, in the exam you just have to focus on this part. So this is the part where your so over here till this point it was just general knowledge. This is the part where your sub point 4 actually starts, where you say, okay, this is a convexity formula and these are the numbers that we have to take into consideration, and your delta YTM, the change in YTM is 2%. 2%, that is 0.02. 2% is 0.02. Okay, so therefore, if I want to calculate the convexity, this is V plus, that is 10,204.05. Add to that V minus 8734.35 minus 2 into 9431.5. The entire term divided by 9431.5 into 2. Acha, into 0.02 raised to 2. So if we do the workings, the numerator over here 10,204.05, 10,204.05 plus 8734.35 minus 9431.5 into 2, which comes to I think 75.4. Acha, if I want to alternatively calculate this 75.4, I can always calculate it as a difference between these two. So if I take the difference between these two, ये वाला जो gap है and ये वाला जो gap, if I add both of these gaps, my answer has to be 75. It definitely, if I take the difference between these two, loosely speaking, this is approximately 45 rupees, and loosely speaking, this difference is approximately 31 rupees. So if I add 75 and 45 and 31, it comes to approximately 75. So this is the numerator, this is the convexity. Divide this by, let's say, 9431.5 into 2, which comes to 18,863 into 0.02 squared. So this is 0.02 squared. So this is 0.004. There are 3 zeros. So over here, this will probably be 75.4 divided by, this is in the denominator 7.54 or 55, and hence over here this is 75.4 divided by 7.55 comes to 9.98 or 99 as the case may be. So this is called as a convexity. However, if you want to find the convexity effect on price, convexity effect on price, they tell you, like for duration, what do? You find the duration, then multiply it by the delta YTM. So if there's a 1% change, then 1%. In a similar way, the convexity effect over here is C into delta YTM squared into 100. So over here, this is 9.98. Again, you are multiplying this by 0.02 squared. So essentially, what is happening over here is, if I want to find the convexity effect to this number, that is C, I will again multiply delta YTM squared. So essentially, this delta YTM squared will get cancelled. So even if I don't do this delta YTM adjustment, it's kind of an irritating adjustment of why are you squaring. Even if I don't do this, ultimately, if I want to find the convexity effect, it is going to negate. And hence, into this, into 100, so this is 9.98 approximately into 0.0004 into 100. So that is approximately 0.3992, or approximately, that is, if it is into 100, that is percentage, so that is 0.4%. So this is your convexity effect. So if you go to your institute solution as well, they would have calculated convexity effect as 0.4%. And I hope, the calculations over here are just this much of calculations, but the underlying rationale is quite deep. We have tried to explain that in the theory over here as well. I'll share these notes as well. I hope you've got some sense of convexity, but even if you have not, just try to remember the formula and proceed. Duration is something which is, I would say, a little non-negotiable. It is something which forms the basis of a lot of your bond understanding, because the majority of the price change is explained by duration. Convexity does just a small job. So let us say over here, it just does a small job of explaining the change in price, but largely the effect is explained by and large by duration. Like for example, loosely speaking, if the convexity effect is 0.4%, my current price, again, I'm not doing an exactly accurate calculation, but if my current price is 9431.5, to that if I multiply 0.4%, 9431.5 into 0.4%, that is around 37 or 38 rupees of the price change is due to convexity. But that is exactly, if I go to 10,159 and 10,204, that is largely explaining the price change, right? So this is the price change which is due to convexity. Institute just stops over here. It does not have a lot of problems except for this one problem that keeps on recycling, and hence just do that problem, keep your demons to rest, and proceed with the other parts of the bond valuation. I hope this video has been helpful and you have gained slightly better understanding of convexity. If you have any comments, please do let me know in the comments box. I'll see you soon with another video. Till then, good luck, goodbye, and study hard.